Lennar
You are.
Lennar beating on the top and the bottom lines after the bell. New orders also grew by a whopping 19% from the previous year, but shares under pressure after the homebuilder's third quarter delivery forecast fell short of estimates. Our next guest is staying bullish. He's got a $198 price target on Lennar. Says the builders offer an attractive buying opportunity with, quote, undemanding valuations. Joining us now for more is John Lovallo, homebuilder analyst at UBS. John, great to have you with us.
Thanks, Melissa. Thanks for having me.
So the shortfall in delivery forecast, that doesn't bother you. How do you explain it?
I don't think that that's really the concern out there today, Melissa. Honestly, I think volume was actually really good, and I think the expectation is that that will continue. And I think Lennar has really kind of done a very nice job of stimulating demand and keeping demand sort of even flow through the cycle, through use of incentives and some of their advertising mechanisms. I think the real concern is the trajectory of gross margin and what's implied from the third quarter into the fourth quarter, which would imply a pretty good ramp. I think that investors are kind of, shooting first and asking questions later when it comes to, back half loaded outlooks. And I think that's really what's going on here today. There's also other questions about capital allocation, the land spin that they're talking about. There weren't a tremendous amount of answers there. Also, some of the multifamily assets that they're talking about selling, I think the sale proceeds were under question there a bit too. So a lot of moving pieces here, but I don't think it's on the volume side.
They were careful to talk about managing expenses as well as just the total home building costs, John. And I'm wondering, from your standpoint, are costs going to go lower here? What is the biggest driver of the cost increase that we saw in terms of the total home building costs year on year? Because it was up year on year by $600–700 million or so. And is that driver going to abate? In other words, if it's labor, it's probably not going down.
It's a good question. Interestingly, the builders in general, Lennar specifically, has done a really nice job of managing costs. One of the things that has been at the cornerstone of this kind of rally. And construction costs on a quarter-over-quarter basis were actually down slightly, call it 1%. I think they were down high single digits. On a year-over-year basis, the bigger cost pressure comes in terms of land and land development. And that's something that is going to remain a pressure. Now, don't get me wrong, there's also pressures from a tightness in labor. And if we do see a ramp in volume, you're going to see some pressure on some of the commodity costs. But I think in terms of input costs, direct costs, the builders have done a great job of really managing those expenses.
What are your expectations? I mean, in terms of your bullish thesis for home builders in general, in terms of the rate backdrop?
So it's a really tough call, right? I mean, certainly not an economist. My view would be that rates are probably heading down at some point. When that happens, tough to tell. We've had a nice little pullback here more recently. I think the builders, though, more importantly, are positioned to really execute regardless of where rates are. We saw them executing at a very high level, even when rates were, as high as 8%. And they've really kind of figured out how to keep the demand that is out there, and it is strong demand, moving through the use of these.
That's because they're buying down mortgages, right? And they're providing incentives. So they can keep it going at 8% mortgage rates, but that's not great for them, right? So in terms of your forecasts, like how much you're factoring they're going to have to support sales through incentives, how long does that last?
So we're not modeling any sort of relief from interest rates or incentives in our models. If we do get that, that will be sort of icing on the cake. I think the builders, though, have figured out how to take cost out elsewhere, so they can use those incentives to keep demand going and still maintain margins that are 200 to 300 basis points above pre-COVID levels, which they're doing.
One last question. Just recently, we've seen a drop in the 10-year yield and some relief on mortgage rates, John, but we haven't seen that usual rally that we've seen in home builders. What do you make of that? Do you think people are just sort of getting concerned about the rate environment overall, about valuations maybe, where we've come?
I think the most recent concern out there has been related to inventory. We've seen a pickup in existing home inventory across several markets, but context is very important here. There's 1.5 million single-family units out in the market today. That is a full 1.5 standard deviations below the historical average of 2.4 million units. So inventory is still very low. The inventory that has built in certain markets is more of a normalization towards kind of, average levels more than anything else.
John.